right here, this is kind of a breakout, but let's go back a little bit. Okay, so if you're following the basic strategy, like in a run like this coming down here, you're only trading the master pattern on one side. So when you see something like this, where you have a swing high, swing low, and then now you're at a swing high point, you have that directional bias, which shows you like, hey, the tide is going down. So what you're doing is that you're selling the swing high points and then trying to get through value. This is the established value of this general area. You're just trying to get down through that value. So you're basically putting the odds in your favor by using that directional bias and trading only, you know, that if it's short, I'm only trading the swing high points. And what that does, they're not all going to work out, obviously. But what it does is it gives you a very strong position. So when normal or most people are shorting at the breakout because they feel like, oh, I don't want to miss out, they're putting themselves into a very possibly weak position, to where if the market puts any pressure on them against that idea, it's gonna be very easy to crack. Whereas if you guys are trading in a short market above value, it's gonna be much more forgiving. Even if you're wrong, sometimes it'll usually put you into the money and give you the opportunity for it to get through value and put you into a run. That's really the difference with understanding that the whipsaw master pattern, whatever you want to call it, this pattern that happens over and over and over and over again. Right here, it happens. Right here, it happens. Right here, it happens. Right here, it's happening. And here, it's happening over and over and over again. You guys understand the frequency of this pattern and the power of not understanding it, how it could destroy you. And you guys are harnessing that power. And that's really what makes you guys different from everyone else. You take the Widowmaker pattern and you basically befriend it and understand it, and then pair it with something as powerful as an existing trend on a higher time frame. You guys can see that that's really, that's really what leads you, and what I feel to the deepest understanding of price action. That's really the conquest I went on when I first started studying this methodology and looking. I ditched moving averages. I ditched everything else. I put it aside. I'm like, this is what everyone looks at. I don't want to look at anything like that. So studying the market maker pattern, studying all those things, those resources, leads you down the road of asking questions like, why do people lose money? Why? And it's really just two things. It's what I think is the pain and pleasure response, is that people, when you're in profit, it's hard to take the profit because it feels good and you don't want it to stop. And then you combine that with the pain response, whereas the minute you get out of the money, you feel like you want to close the trade immediately because you want the pain to stop. That is why it's so hard to book a profit, and that's intuitive. You guys don't have to learn that. That's something you're born with. Nobody likes to feel pain. So you have that decisive action at the wrong time, just naturally born with it. But then also you combine that with this pattern that's happening almost all the time in the market on every time frame. So you have the probability of being out of the money on almost any trade at any price level you pick. You will eventually be out of the money. Now, some entries are better, some are worse, but for the most part, if you just buy the market or sell the market at any time, this pattern will almost certainly put you out of the money and put you into that stress position. So if you understand those two things, you understand your pain threshold and where it's going to be pushed, and you understand this pattern, those two things, in my opinion, are the key to just at least understanding how to position yourself in stronger trades. That's really all it comes down to. That's really all it's about. Is it easy? No, it's definitely not easy. But you can understand that without understanding those two things, you're kind of flying blind, in my opinion. So anyway, I don't want to go too deep on that, but I just felt like there's an opportunity to kind of drill that in. I know I've talked about it before, but the simple things I feel like are sometimes the most powerful things. So
Wait, could I make a quick comment about that? Or not so much about that, but more so On pound dollar, I was trying to illustrate what I thought was going to happen with that breadth, and it's pretty much exactly what's happening right here on the 15-minute euro dollar chart, where we had a master pattern and then it pulled back, and we can see that it bounced, that it rotated right off of that previous master pattern origination point. So just a little, the snap up before it started pushing down to the short side on your 15-minute chart, if you could highlight that.
Where was it?
Just when it pulled back and then it rotated off of that previous master pattern. Yeah, right there next to your mouse. Yeah, so it pushed, yeah, it came up and then it rotated off that previous master pattern.
Oh, okay, right. Okay,
the high of the range. Yeah, so that was pretty much the gist of what I was trying to highlight on the pound dollar, where you have your clear trending direction, and then a master pattern starts, or you get a whip and then it pulls back. Then it rotates off of a previous master pattern origination point, and then you can, so one, you're getting in on an expand high in a short market, and then two, you can manage your risk off of that previous master pattern origination point. So, that's that's pretty much all you need. So risk management, and then a reason to be looking to get into a trade there in the first place, because it's an expand high against a short market. Actually, if you want to scroll back, excuse me, the example that you're using on the rundown, it did the exact same thing. Yeah, right here. So master pattern, and then it goes, and then that's basically price settling. So it pulls back. So it goes through an expand high or expand low. It breaks the expand high or expand low point, and then after that, it pulls back, settles on the master pattern origination point, and then goes and then continues in the overall direction. So just kind of thinking about the mechanics of why that actually happens, it's, those expand high and expand lows, they're just to pick up liquidity. So as people, and then once they have enough liquidity, then it'll take off, and it usually retests it. Luckily for us, it usually retests a previous master pattern origination point and gives us that entry that we can manage risk on. But yeah, it happens over and over and over, which again is why I brought it up for pound dollar.
Yeah, it goes back with that analogy I think I said, I think it was a week or two ago, but these especially with ATS 4.0, you have less expansion lines, and they're more significant expansion lines, because there's price activity that's confirmed to be happening in that area. But you can see, basically in trend, when you get lower, here's each expansion line is lower than the last, and that was kind of what we were talking about. It's like, which way are you climbing up? Are you climbing up the ladder, or are you climbing down the ladder? So you can almost think of these expansion lines in trend are like stepping down a ladder. And if you kind of think about that way, you can see, like what Shane was saying, this comes up, this is a swing high point, and it's communicating with this previous master pattern, showing us, hey, we want to hold that price level. So it's basically saying, no, we're not going to start walking up the ladder. We're still walking down the ladder. So just this information there, and there's different situations and different things, that play out slightly differently, but overall, it's going to be mostly the same. And if you combine this type of situation with the fact that, hey, my higher time frame is going short still, then this becomes even more significant. There's a lot to be talked about when you come up and meet a expansion line like that and get a big reaction off of that. This looks like it was pretty fast when that happened. A lot of whipping right there, but anyway, it does happen over and over again. And that's going back to, you have that picture that's being painted for you. You start, if you want to get some sense of the picture, like you want to get the general landscape, well, that's your higher time frame. That's where you start. If you're trading in the morning, like London, New York, look at the 4 hour and the daily. That'll give you the picture. Generally, you don't really know exactly what's in the picture yet, but it's like, okay, it's a snowy day or it's a sunny day. You get some idea of the overall direction. And then these, you could think of your lower time frame. These are these individual brush strokes that are making the picture clearer and clearer and clearer. So you have some of that picture on your higher time frame, but once you get enough brush strokes on the smaller time frame, eventually it starts to become clear until you're like, okay, I get it. That's what it is. I get it. There's enough there now. I totally get it. And until you get that feeling where I totally get it, then you don't really need to take any action. Just because the market runs 100 or 200 pips, don't think like, oh, I missed it, like I'm not doing this right, or get down on yourself. There's always movement. And your job is not to get every single bit of movement. Your job is to be an expert at waiting and understanding the movement you engage with. That is your edge, is understanding your plan. It's no one else's plan. You can't get the ideas from anyone else. You need to look at things that you see the picture, and with that picture comes a management plan that you understand. So until you get those pieces, your job is just to sit there until you get that. That's really what it's about. It's not about being in a trade all the time. It's about being in trades that you really understand and have worked out the parameters that work for you, and that you can effectively manage. That's really the biggest thing. Like I think Shane said a few weeks ago, sometimes you turn a 5-minute trade, turns into, you become a long-term investor because all of a sudden your 5-minute trade goes against you, and then you start looking, oh, it'll come around. And it goes through all of your threshold prices that you were using to manage your risk. Next thing you know, now I'm 30 pips down. Oh, well, what's the weekly look like? Maybe I could just be in this for the week. Oh, the weekly's in my favor. Well, you've already violated all your risk parameters for that trade, and it's probably your risk parameters were controlling the amount of leverage and things you were using to be smart. But now you weren't ready to go 40 pips negative on that opportunity. So you want to keep inside those guidelines that you create for individual opportunities, and make sure that's where that discipline comes in, which is what everybody who gets into trading starts talking about. Oh, I got to be more disciplined. Well, that's what you need. You need to be disciplined to the parameters you set for the opportunity, and make sure that you don't start changing up the plan. You don't want to change the flight plan mid-flight, I guess, is maybe a good way to talk about it. Okay, so as far as going down, that's hopefully you understand what's going on. I spent a lot of time on euro dollar, but again, like I said, these lessons that I'm talking about translate into whatever you guys are looking at. It's all the same stuff, and the goal through these webinars is for you guys to do your own analysis on it and look at the higher time frames, and then break it down to, okay, what where go to the monthly, go to the weekly, go to the daily, the 4-hour and 5-minute, and figure out what are all these time frames telling me, and what is the appropriate behavior to interact with each time frame. So as of right now, it really depends. This 4 hours and a hold short. We've had, how many was it? 1, 2, 3, 4, 5, 6, 7, 8, 9 expansion legs out of this single box right here. So that's pretty significant. So eventually we're going to hold that. So I would definitely be paying attention to this as a major threshold price around here. And I would not be surprised if we don't get a significantly good size move away from this exact price level. So whichever way we hold below this price level, I'd say probably significant move to the short side. If we get above, we're going to probably get a significant move to the upside. So I would really just pay attention. I don't think there's any trade right this very second. If you're going to look to go short, I'd wait for a new box to give you some framework, and then short out of that area and use that new expansion level or mid box point to manage that idea. But it's really just fishing for what is the outcome of this massive 9-leg expansion pattern. What is going to be the outcome of this is really the question I'd be asking.
Quick little point, Euro USD on my notepad that I do use to make the volatility report, it got put on there, but then crossed out because I didn't feel like I could, I felt like I was a little bit too late, a little bit later than I would normally like to be. But yeah, Euro dollar is starting to pick up. It should be moving here pretty soon. So that should be cool.
Yeah. So we'll take a look at some other stuff here. There's quite a bit of questions that flooded in here, so let me go through these real quick.
Real quick, there was a question here from Veronica. So Veronica asks about liquidity lines and basically when they're taken out or not taken out and what that could potentially mean. So and I bring it up now because we've actually got an example here on Wade's 15-minute where it came down and it didn't quite take out that liquidity line. So you're going to see behavior like that when the market is in an expansion phase. In a trending phase, it will pretty much like a magnet seek out more liquidity to continue the push until it finally goes back into expansion. And, at that point, the trend's kind of over. So yeah, it basically just comes down to what phase you're in. Sometimes you can think that you're in a trend, but you're really not. And that's when you're going to find that behavior. Just when you get that big move that happened, like the big move of the day on whatever pair you're looking at, but then it just kind of stops, it sputters out, and then it just, reverses and goes right back up into the range. And then you look at it, it's like, oh, okay, that was just an expansion leg. It just happened to be a really big one. That's kind of what's happening right here. So this is kind of you don't know it at the moment. You don't know exactly which leg is going to take off. But this, price going down there on the 15-minute and stopping at the expansion line, or excuse me, the liquidity line, kind of just goes along with letting you know in the moment that, okay, maybe this is just an expansion leg. It's going to just come back up into the range. We're probably going to be looking for a little bit more information. So you don't know exactly when the trend's going to take off, just the likely direction. And then you just do your best to get in and expand high or low against that trend to hopefully be in the trade when it finally does take off. You can look at the overall timing. Like Wade mentioned, this has like 9 legs of expansion. It's probably going to start moving soon. So if not this leg, then maybe the next one and possibly the following one after that, because they usually don't go much further than 9, 10, 11 legs. And those are already starting to push it. So, just looking for an expand higher, expand low against the overall trend, and then try to be in a good position so that if it does take off in trend, you're already in it at a strong entry.
Mm-hmm. So, yeah, if you guys want to go back, just maybe a little homework assignment, go count expansion legs. Go count how many expansion legs you get until you get some sort of deviation or a new box. So if you look like here's 1, 2, we had 2 on this one before you got a new box. This one we had 1, 2, 3, and then we got a new box. This one 1, 2, 3, and you got a new box. So, and remember that it doesn't really matter the time frame; it's all relevant. This could happen right here. This could happen on a daily time frame. This type of stuff. So it doesn't really matter. But in general, if you go back and look, what is average, you'll probably find a lot of 2, 3 leg expansions, 4 leg expansions, but a 9 leg expansion is kind of rare. So that shows you something special is probably happening at this point. So something to think about there. So here's a question from Fred. What time frames would you suggest if I was able to trade the late London session and New York session? I've been using the 4-hour for support and trading off of the minute, 5-minute, and the 1 minute. So here's a problem, Fred, with the 1 minute. Let me jump over, and I don't know what your spreads look like or what's going on there. With the 1 minute, you can trade it, but you either need some really big movement to interact with, or you need really tight spreads. You can usually, like on Dow CFDs, usually at least with FX Choice, the spread is pretty tight. If you're into trading CFDs, I don't really feel like they're that scalable, but you could do it. Another thing with CFD markets too is that the brokers have a lot of control over just turning off the markets because of the liquidity issues. So you can be in a trades and they can just decide, hey, you know what, we're going to turn off that market. So CFDs, yeah, they usually have high leverage. You know, there are some cool benefits to be able to trade those markets, but remember, you're basically trading with the broker. That's where they pocket your money on CFDs. Of course, if you win, they got to pay up, but that's really something you got to be careful with on those markets. But they do tend to have tighter spreads and instant execution, because typically the trades aren't going to live market. That's why you get instant execution, because there's nobody to fill you other than the broker just basically trading with you. But with a 1 minute, you get wider spreads on actual markets. Like typically Forex, you are typically going to the live market, and so you're paying more, actual transaction fees. And when you trade the 1 minute on shorter time frames, and I know there's a few questions on here about trading short time frames, you got to think about what's your average trade that you're trying to get. Let's take, for instance, like let's pull up like the 1 hour. I wonder if the 1 hour's okay. So the 1 hour is starting to come around, and let's say that it was blue, and now you're trading. You can see it's the same type of patterns that happen on the 1 minute. You don't have a blue candle yet, but it is coming around. So you can see we got a red box above, so it shows that price action in this time frame. The institutions are starting to move the momentum up to the upside, at least on this time frame. We came down below, broke through the swing low point, had an entry right here, back up through. You can see we got through the average price, and then boom, you got a big push up, and it got hung up on this previous expansion level right there. So it's the same thing, but when you trade short time frames, now you got this 1, maybe 2 pip spread that you need to think about. And if you're only taking, let's say your spread is 1 pip, and you are trying to find 5 to 10 pip trades on a 1 minute chart, realistically, with the framework you're working with, this was, how big was this? This is like, 13 pip trade. Okay. So you're talking, and you're not going to get probably the entire 13. So if you're paying 1 pip, and let's say your average trade is 5 to 10 pips, you're talking about 10 to 20% is expense to get into those trades. And that adds up when you're not booking bigger trades than 5 or 10 pips typically. So I guess, personally, I would be careful with the 1 minute, because you really need to be pretty dang amazing at nailing your entries if you're trading a 1 minute chart. And not to say it can't be done, but you're paying a lot of transaction cost, and you're going to be out of the market a lot, because you're only looking for 5-10 pip pops. So again, those transaction costs are going to add up, and it puts you at kind of a big disadvantage, percentage wise. You're kind of starting from a big handicap. Now you jump over to a 5 minute, and this is something also I'll mention too. You could look at, you got the spread right here. If you're running the bid and the ask, you can just look at the spread in relative to the general price action. And if that spread looks kind of like, it could like eat the previous price action, like it's like wide, like then that could be kind of an indication that something that's going to be difficult to trade on a 1 minute. If you jump over to a 5 minute, then you'll notice that you got the same patterns that you're working with, but now the spread becomes much less significant, because now your average trade is probably going to be 10 to 20, maybe 30 pips is what you're really looking for now on a 5 minute chart. So of course you're going to be in the trades longer, but remember, time in the market is kind of the cure-all. The more time you could be participating in the market, eventually it's going to do what you want it to do eventually, right? So anyway, that looks like could be a possible setup too on the 5 minute. If you look at the 5 minute into trade the 5 into the 4 hour. I'm not telling you guys what to do, but you have a short 4 hour. If you short off of this previous expansion level, could be a possibility to trade that down, get through this box, and keep working short. Looks like it is getting hung up. Not telling you guys what to do. You guys make your own decisions, but interesting, it is holding that architecture. Also, you do actually one thing you got to think about too at this time is that we're coming out of New York session, so it easily could go flat as well. So you want to think about that as well. But
Okay,
anyway,
wait, real quick. I just want to make a point just about what you just brought up. That's pretty much the little setup. Whether it works out or not is kind of irrelevant for this, but that it's in trend. You know, the market is short, and then it pulls back, and then you've got clear risk. You know, if you were to enter right there, you're not going to risk any more than probably that little just above that wick right there on the 5-minute, because it's very clearly reacting to that master pattern origination point. So that's kind of the bread and butter of what we put out on the volatility report, albeit on a little bit larger time frame.
Yeah. So anyway, that's something you need to think about. So if you're trading short time frames, Fred, going back to your question, it really just comes down to you want to watch the transaction costs. And you want it to be easier to get into the money according to the pattern that you're looking at, or the master pattern that you're working. So I wouldn't go, if you're trading London and New York, I wouldn't go lower than a 5-minute if you're trading currencies. Now, if we jump over to, we'll see what it is right now, and I'll just jump there real quick. We'll look at the US 30. This typically has a pretty low spread. So there's your 1-minute chart, and it doesn't look like the actual market's been moving that much this morning so far. Doesn't look like it's done anything too significant, but you can see that's a 1-minute chart that becomes a little more tradable because your spread is so tight that you can still be in the money relatively quick, and your transaction costs according to your average trade size or potential profitable trade becomes less of a percentage. So you're not at quite a disadvantage. So those of you guys that are, I know it's fun and you really want to trade short time frames, and that idea of just getting in the market and taking, 20 or 30 pips a day out of a market on a 1-minute chart sounds really appealing. But it's gonna be more difficult if you're climbing over a 1 or a 2 pip spread, and your average, you find you're only taking maybe a 5 or a 10 pip trade when you're right. It's gonna be really difficult to sustain that. So I would suggest possibly moving to a 5-minute. You will have less trading opportunities, but they should be a little more significant. You should be booking the 10 and 20 pip trades a little more often with that, and then you'll be paying less transaction costs. So anyway, that's kind of, I'll leave that on there. Hopefully that kind of answers those questions. Someone also, let me see here. I forget who it was. We got quite a few chats coming through. Oh, I think I see it here. Okay, from Rick. Good to see you on, Rick. So is asking about the entries on the faster time frame from the basic strategy point of view. Let me see on the time frame entry. Okay, hold on. This question was a little bit deeper than I thought it'd be. Let me read it one more time because I want to answer it. Okay, can you please cover entries on the faster time frame from a basic strategy point of view on ATS version 4? So you now need to time the entry not just from a counter trend perspective, but from a specific leg of the expansion high and low, the master pattern on the counter trend liquidity. Okay, so I think what you're saying, Rick, is understanding the number of legs that are happening and also understanding the trend. It really doesn't change up the basic strategy. I mean, the basic strategy is if the trend is short, you want to get the best entry you can above expansion on your lower time frame. If it's long, then it'd be the opposite of that. The more legs that happen, and the framework that happens, that's kind of the next level of analysis using ATS, is understanding how many legs potential or how many legs have happened, how many could happen, and then using the reference points created by those swing high, swing low points to understand the potential of what could possibly happen in the near future. But the basics really are, they're called the basics for a reason. It's something to start with, to understand, hey, the ocean current is going this way, and I know that I need to find the best possible entry in that direction. So anyway, that's pretty much. It doesn't really change the basic strategy too much, other than it gives you a little bit deeper perspective into what's possible. By following the basic strategy, if any of you guys are new with us, you are naturally aligning yourself and your trade positioning with it should naturally be putting you into stronger positions. We don't know if they're going to work out because nobody has a crystal ball. But what it really comes down to is having a strong position that you can defend rather than a weak position. That's really what empowers you in the market. Nobody knows what it's going to ultimately do. We're not trying to predict. We are trying to just have strong positioning so that we can maximize profit if it goes in our favor, and we can cut losses small. That's what a strong trade placement does for you. So just by looking at the multi-leg expansions, and you have the new red boxes on 4.0, should just make that a little bit clearer of what the possibilities are and where those significant levels are going to be. So anyway, yeah, nothing really should change from the basics. You just have a little bit more of a microscope on it. And so hopefully that answers that okay. All right, so let's take a look at another market. I know I've kind of droned on Eurodollar for a little bit, but hopefully, like I said, the stuff I'm talking to you guys about, these can be applied to whatever you're looking at. Actually, we're not looking at Eurodollar. Let me jump over. Okay. I'm going to look at Aussie CAD, but the person that requested it looked like they left the webinar. Sorry, probably didn't get to it fast enough. Okay, so one of the questions from excuse me, from Marcus is asking about XRP, which is a little bit out of traditional currencies, especially at this point. So, and I'm not seeing a lot of other, I saw Aussie CAD, but the person that asked for it looks like they left. So we'll take a few minutes to talk about crypto. I don't have an XRP chart on this specifically, so I don't think, unless they added it. No, we have BTC, Ethereum, and Litecoin on here. But let's talk about XRP. So XRP, the play on XRP right now is really dependent, I think, on where your trade placement is. Again, it's just kind of what I was just saying, is that trade placement is what gives you power. And by understanding the trend, the overall trend direction and multi-leg expansion, whether it's cryptocurrencies, stocks, whatever, everybody wants strong trade placement because that's what gives you choices and minimizes risk mostly. So XRP, I know I'm pretty intimately involved with that. Actually, a couple of us on the team, me also, I got a decently significant position in XRP right now. But the thing with my position, I started building it. I've been holding it a while. And my cost average is down around like 23 or 24 cents. And right now, I haven't checked the price. Let me look at it real quick. Let me pull up my quick reference here. So it's trading right now about 45.5 cents, roughly. So what ended up happening with this SEC thing, I know this is like a big black cloud hanging over the XRP trade. As of right now, I don't think it's probably a great time to be going in heavy from a risk perspective. It really just depends. It's one of those situations, I guess. If XRP is in that situation where don't on any trade, don't risk money you can't afford to lose or that's going to break you. I'm hanging on because my cost basis, my cost average is so low compared to where we're at that I feel pretty good. I weathered it going back down. It took me out of the money a little bit, but like I said, the majority of my position is built around like 20. It's like around the 24-cent mark. So, you know, I feel good. I'm sitting pretty well up in the money on it, and I feel like because the trade placement is good, I've earned the right to see it through. Now, if my cost basis, you know, my average was at like, you know, 50 cents or 60 cents or maybe 70 cents when it had the real big spike a little while ago, you went all in at that point, you'd probably be sweating it a little bit. And now you much more tied to the outcome of the SEC thing. Now, if the SEC clears, if they clear XRP, my speculation is that what can be the worst crypto trade that's happening right now can become overnight the best. Because what ends up happening is that the SEC clears and drops a case. What that becomes is kind of like a stress test as far as like, you know, I guess XRP has now crossed the fiery coals and has proved itself in the SEC's, at least in the SEC's eyes, and now becomes more credible. So it's kind of one of those situations that it either gets destroyed or becomes unbreakable almost. So where we're sitting right now, I guess, you know, if you want to put money into it and you're hanging on to it, we're kind of waiting for what's going to happen. If that gets cleared, I could see it potentially going, you know, I would say at least over $4 for sure. If not, you know, quadrupling the active high. I would say because everyone would be looking at it as like, hey, this is like blue skies ahead now because it's gone through the stress test. If it fails, well, then it may fall apart. And then, you know, I don't know if it'll be worth nothing. Because again, this is also too something you got to think about is that this is only in the US. XRP is pretty well received in other major financial systems around the world. This is only the US. Doesn't mean that they're going to stop with their business plan. So, anyway, it's just stuff to think about. It really comes down to though, where's your trade placement, and are you trading with money you can afford to lose? You know, for me, I put a significant amount of money into it, but my upside, you know, is pretty, you know, pretty big, and I look at for the risk to reward. If they go through, you know, that, you know, it could be, if it really goes, I mean, it could be a 7-figure trade. Let's just put it that way. So, and I have other crypto and stuff going on too, but the upside is, you know, it's decent. So, I'm going to continue to hold and, you know, and I'm just going to let it be what's going to be. But I can't say that it's only because the trade placement is quality, and it's money that I'm not emotionally attached to. So with you guys trading crypto, Bitcoin, everything, I know I got some flack I get flack for every Bitcoin video I make. So I'm like, it's kind of annoying, but that's what I'm saying with Bitcoin. When it's going parabolic like this, number one is that you don't have a whole lot of framework to work with at these high prices. And the prices are high. We've already had such a significant move past the active $19,000 high that what I'm thinking of is there quality trade placement is number one. And also too, if you want to get into Bitcoin, then understand you could risk a significant drawdown. You know, there's a lot of things that can happen. So trade placement really is kind of the cure for that. It gives you the choices. So I'm not saying don't trade Bitcoin or don't get into those things. I would just wait for some more framework. In fact, let's just take a quick look at it while we're talking about it, since we can get onto that chart. Okay. We'll just take a look at the daily real quick. And we'll throw the monthly up here. Okay, look at that monthly chart. This is, you guys remember, if you don't think back too long ago, this is exactly what this felt like if you guys were trading Bitcoin in 2017. Exactly what this felt like. And then you had almost like, I think it was like 70%, something like that, correction down to here. So, you know, when I say on the Bitcoin video, I wouldn't be jumping in, and people are, as long as it continues to go up, I'm going to look like a schmuck. I get it. I totally get it. If it goes to 100,000 and I said, don't jump in on a parabolic move, people are like, what an idiot. I'm just saying, from trading over 10 years and looking at, you know, expansion patterns and looking at this type of stuff, my experience is that when you jump in on a parabolic move, you're usually going to get cleaned out. Now, this may be one of those times where it just continues to go parabolic to 200,000, gives everybody that is jumping in with their life savings the perfect opportunity to actually take their money out of the market while holding high prices. You know, that would probably be a first, but typically it's not going to happen. When the hype ends, you're usually going to get a pretty big collapse. And that's all I'm saying. I don't know how far it'll pump, though. Hype can go a long way. Look at the penny stock world. I mean, you get stocks, especially right now, like GameStop, all this stuff. You got stocks that go from $2 to $50 in a few weeks based on hype alone. So hype is very powerful. But the key to, if you want to trade hype, it's great. But look at your trade placement, look at the expansion levels that you're working with. You guys can just look at the videos that we made before. It teaches you how to draw your own boxes that should be accurate enough to understand what the deal is. And you guys can do those on your crypto charts as well. And just try to get better trade placement. You notice that the best trade placement, if you're trading the daily, the best trade placement we had was according to this last expansion box. Below the average price, we didn't have a full-blown expansion line until we broke through the high of the box right here. But you were below that value point. You notice that was the best last opportunity that we had. So I'm saying trade the hype. Love it. Yeah, hype, bring it on. Let people pile in. But unless you got some framework to work with that gives you some reference points, you're going to be out here just hanging it out there, and you're going to be subject to this possibility. That's all I'm saying. So, like I said, I don't know why I get so much hate on the Bitcoin videos. I don't think people really watch the whole things, but I'm just trying to say, be safe. Last thing I want to see you guys do is lose money. You know, I don't think trading needs to be as expensive of a lesson as it was, especially for me when we all got started. You know, we flushed money. It looked like a gas pump going down, you know, backwards. It was terrible. And it was because of chasing things. It was chasing things in terrible trade placement and not understanding, you know, what the market framework was. You know, it's chasing different strategies, changing up your strategy day by day. You know, one day I'm a 1 minute trader, next day, you know what, I'm a long-term trader. Believe me, I've seen it and done it all. And the stuff I'm telling you guys is just, you can do whatever you want, but I'm just trying to keep you guys as safe as possible and keep your trade placement quality, because that's really what earns you guys the right to make decisions and be, you know, to defend your position. So anyway, I don't want to drone on too much. I'm going to see if there's a few more questions we'll take, and then we'll probably wrap it up.
Hey Wade, could we, Nikki a little while ago, it was, I think we might have missed his comment. He asked us to just do a quick broad view of the major pairs. Could we do a quick top down on some of the majors?
I'll do a couple of them, but I don't know if I can go through all of them. We'll just jump through. So we'll throw the weekly, we'll do the monthly, we'll do the, do the monthly and the daily over here. Okay. Turn on auto scroll. Okay, pound USD, monthly's long. Not a great, well, oh, this is the one we did in the volatility report, isn't it? Yeah, so monthly's long. We're through the swing high point. We had a swing low, swing high, swing low, swing high. I think Shane said on the volatility report, definitely possibility we could be going short. So on a weekly perspective, I would say that the possibility is, providing we hold below this threshold price right here, definitely a possibility we're going to work down to this expansion level. So I think, anyway, you guys got the volatility report to tell you what's going on with that. So I'm not going to spend a lot of time. Aussie dollar. Okay, monthly's long. Master pattern origination point, swing high, swing low, second leg, third leg's up here. Looks like it wants to touch that third leg right there, wants to confirm that. So that's going to be at the expansion level. Looks like their monthly candle is shrinking. What day is it? It's the 16th, so we're halfway through this month basically. So right now I would say, if we're going to go long on this month or short on this month, is probably going to really be dependent on how we interact with this average price right here. If you start to see price build above on the daily, that could be a possibility to go long in the monthly direction and try to attack the high of the month. If we get through the high of the previous month, chances are we're probably going to easily gap up to through the liquidity line up here. But I think right here, this current expansion line is going to be pretty telling. So I would see how price interacts with that level, see how it dances with that, and gives you clues around that to see if it's going to go long or short. But I don't know. It's just really, this line is telling for that monthly direction right now. I'd really pay attention to what kind of rejections and confirmations you get with this line. Okay, we did Euro USD. I'm gonna skip USD. Well, we'll look at USD Franc. Okay, so this is interesting. So monthly, we're new on the monthly candle. So this is our first, we've confirmed our first blue. So this is our second blue month. Definitely interesting. I don't see any great trade placement right this very second. Well, okay, here's a strategy you could have for this. Let's look back on the origination point for the monthly. Swing low, swing high, swing low. Third leg from this origination point. We're turning off. So what I'd like to see on this is, I think there's a possible longer term opportunity, and I'm talking about over the course of probably, well, let's see how long it take to work down. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 months. Okay, so this is possibly a year or more opportunity to work towards this active high, but your trade placement is right now, possibly. What I'd like to see, if you're going to work towards the expand high point on the monthly on USD Franc, I'd like to see you hold above this liquidity line level, because that represents the last swing low point that you broke. I'd like to see it hang above that. You can take a look on your daily time frame. What's the price of this? See, whoops. Okay, 0.91800. Okay, so 91,800. Basically this level right here is the liquidity line level. So if you're going to start building a long position in this, I'd like to see price generally hang above this level from this point on. If you get below this expansion line right here, which is the last expansion line we came through, then you would start to look at, is the monthly going to rotate? Possibly. But pretty much building a position, if it comes down, test this level, you see prices hanging above, probably a good chance you're going to get a nice long move, and it has plenty of liquidity to blow through to get there. So I could see this being a pretty nice move over the course of the next year to the long side. But like I said, I don't know for sure if it's going to happen or not, but it would be contingent on really hanging above this this price right here of that expansion line. If it gets below, it doesn't mean it still can't go, but it means that you could end up seeing another yellow candle coming and testing the low, or possibly a continuation of the downtrend, because we also do have liquidity down here it could work towards as well. One of the two is possibly going to happen. So it really comes down, it's not about calling it right, it's just about understanding the threshold points, and you're either right or you're wrong. Doesn't matter. You're going to win some, you're going to lose some. It's about quality trade placement and quality management points. If this is going long, then even though this is going long right now, if you start building a position, it's still considered quality trade placement, because you're shooting for up here and you're below that expansion line. So according to that specific idea, you are early in the trade. So, but again, we'll have to see how it works out and just kind of treat it accordingly. I'll do two more. Euro pound. Euro pound is short. Let's look at the last red box. 1, 2, 3, 4. 4 expansion legs. This turn, these last monthly turns, looks like it turned off of the liquidity line, the last swing high liquidity line. So that's a reasonably decent clue that we could be headed short. Here's a swing low point, that liquidity. So question is price going to hunt out that liquidity? Say it's a good chance. The way it's forming, it's a good chance. So what I'd probably suggest doing is hanging short on this. I don't know if there's any great trade placement. The only clue I see right now is that we had a box right here. Looks like we wicked up and touched the middle of that box, and now we're coming back. So possibly if you do see a yellow candle right now going short on that, could be a possible place to jump in, going short and then just riding the momentum, just shorting. But I would control your risk. You know, the worst I would go is, you know, pretty much above the middle of this box. So, you know, I would look for that momentum to kick in pretty much right away. And that's, you can trade below average price like that in trend, but those trades, if you're trading those momentum trades, like something like this right here, you want them really to take off, and you want to use that last kind of pullback as a place to manage your risk. You don't want to wait to go, you know, all the way back through the previous expansion line, because it could be pretty far away. So in this situation, you see a yellow candle, you really want that candle to stay yellow and start making immediate progress to the downside. If that doesn't happen, you got to start questioning whether, you know, the validity of the trade, and maybe need to get out and reassess. So you just have to see how that plays out. But I would probably end up sticking short with this on the monthly perspective, and just see what happens on the daily to confirm that short direction. We'll do one more. We'll do USD CAD. Okay, so we got two red stacked at pretty much the exact same price level. 1 leg, 2 leg, 3 leg. This one looks like almost like a stop taking move on the monthly. So that could be using fuel to power this. So this one's a little bit late. Ideally, you know, this would have been the first monthly rotation. So trading it up here, if you were trading the actual expansion phases, would have been better right here, trying to hold below this swing high point. You have this liquidity line here. That's one thing, you guys, when you take out a liquidity line, you can almost paint that level forward. And, you know, for instance, like right here, you took out this liquidity line, or let's look at this one right here. So we came through this liquidity line right here. Remember, that represents orders being released in the market. And what it really represents is people's pain threshold being pushed to a breaking point. When people's pain threshold is pushed to a breaking point, it causes them to take action and actually close trades, and then people usually open trades too, because they perceive it as a breakout. So what you could do when you come through a liquidity line, you can take a line, stick it on that liquidity line level, and then you see how this price action came down, ranged out right there on that, and then started to build above. That can be an entry point as well, and you're managing it off that previous liquidity line level that was there. And you can't see it, but let me put it down below a little bit. But you guys see how that even in the future, that shows you what are they doing with this liquidity. Now, if they came through and then you saw price started to hold below this line, then that could be a possible place to short, and you can use that liquidity line to manage risk as well. So it just depends on the situation, but something that you could have legged into this trade to the upside based off of that. Same thing right here. You came through that liquidity line. You can take a line, stick it up here, and if you're trying to short into a monthly or a weekly, you can use that to help monitor your risk, because that is the level that they took the liquidity from that triggered it. It's not an exact level, but it represents kind of a general cloud around that. Sometimes it's very specific. Sometimes it could range out in that general level, but if it holds below, that can sometimes answer the question, what are they doing with that liquidity? Are they using it to push the trend, or are they using it to turn the trend? So you guys, it's just another little tool you could use with the map. Again, it's all specific to the circumstance. But as you guys get more familiar, the longer you use ATS, these are those things that start to emerge, those repetitive behaviors, where you start to say, okay, I've seen this before. They're using that liquidity to turn the market. You know, you take something like that, go back up here to where the market turned. This is that big move right here, coming up through that liquidity. You'd see the market ranges out. It's not holding. No one's coming in. Then the whole move collapses on itself. Well, you have that now. So when you're shorting into something like that, you can be looking at the bigger picture here. That bigger picture is telling you, yeah, there's a possibility to short into this rotation. That gives you some more confidence to short above these expansion lines right here, in expectation that you're going to get a move continuing down. So anyway, that just a quick lesson there, something to be taken from that. As of right now,
could I just throw one thing in there? I actually see a lot of emails of people that that actually kind of intuitively, because we don't really talk about that all that much, but a lot of people actually intuitively do that. We'll enter a trade based on the liquidity line. But one thing that, you know, everyone knows, I tend to be a little bit more technical about all of it. Using the liquidity lines like Wade's talking about, and potentially going back and looking for price to come back down into the range. So on that example on the monthly of using it to go short, it really just comes down to what phase is the market in. And this is kind of what we're hoping to get out of ATS 4.0, where it's just clear as day that, you know, where you don't, your whole screen isn't cluttered with lines, and you can very clearly see that on the monthly that thing's not trending. So the likelihood of an expand high or expand low, even if it looks like it's starting to trend, the likelihood that it'll reverse and come back down up to that value line is pretty high after it takes out that expand low in this case. But, you know, either direction. So it's just what Wade just said about, you know, using it to get into a trade. On the example that he showed on the way up, that was when the market was, you know, more so trending to the long side. Whereas this example that we've got here on the monthly, where it popped up through it and then you kind of use it to manage a short trade, it's in expansion. So we can see that this is in an expansion phase. It's not trending, and it's very likely to rubber band back towards the back towards value or the master pattern origination point. So that's really the key thing from what he just went through. What phase is the market in? Because that's going to dictate the behavior.
Okay, guys, I was going through your comments here. Okay, it looks like I'm gonna touch Aussie CAD real quick. It's like Marianne's back, so if I could find it here. Okay, we'll do Aussie CAD real quick, and then guys, we're probably gonna wrap it up. I got my lunches here, and it's getting cold, so appreciate you guys hanging in there with us on here. Okay, so monthly. So interesting things happening on Aussie CAD right here. Kind of the same thing we were talking about in trend. What do we have to work with? We got architecture, right? The market's the market has built the parameters for us. One question I'm going to answer very fast. So someone asked, I forget who it was, but they asked about what's the relevance of master patterns or expansion lines? Like, how far back do they matter? And the answer to that question is, when you get to previous levels where you see you had an expansion line, and price starts to react off of that level, it becomes relevant. I don't care how old it is. It could be from years back. It could be from 10 years back. But if price interacts with that level and you see that it starts to stop at that level, maybe reject off of it, or get through or range out, now it becomes relevant. So the market kind of tags in. It'll get to a price level and kind of tag in what framework is relevant for that situation. So let the market tell you. It's its own. The market is its own tool to determine what it is that we need to pay attention to. So until that's part of waiting for things to work out, waiting for that painting to become clearer and clearer. Let the market paint it. Don't force it. If it's ignoring something or it's not using that framework, then it's probably something that you don't need to pay much attention to. So we'll just wait till it is. You know, we're not trying to predict. We're trying to react to. I mean, we come up with some ideas of prediction, but until we get reactions that confirm those predictions, it really doesn't matter. So right now we're looking at getting, we're turning off of this master pattern expansion line right here on Aussie CAD. We got our first yellow candle, hasn't confirmed yet, but could this be a situation like we just looked at on the last pair? Is it turning? And also too, we have liquidity right here. So I would say this candle, you notice that this candle right here is hanging between this expansion level and this liquidity line level. Those two levels are significant right now to play with or to understand. Possible opportunity right now on Aussie CAD. Literally right now, swing low, swing high, swing low. We broke through the swing low. Could this possibly end up turning? It may come down and test this one down here. But could this be a setup to attack the swing high? Because if they hold this liquidity right here, and where you can see our monthly candles at the bottom, could that possibly lead to the next 2-3 weeks coming back up and attacking the swing high point? You see, we're kind of stretched. This candle's pretty even looking. It's between these two levels. Could this be that the support of the trade that we're coming into, and you know, you look at your 4-hour time frame maybe, or your 1 hour, you start to see symptoms of a trend reversal on here. Could that be a possible opportunity with a low risk? I mean, you could possibly, I'm not telling you guys what to do. Again, I do not give trading signals on here. You need to do your own work so that you can manage your own opportunities. But hypothetically, could this be a pretty decent risk to reward right here to build a position in and around this neighborhood? Because on a 1 hour, you could start building a position using this expansion line as your ultimate risk. You want to hang above this general line, building a position and working back to the swing high point. You're essentially saying, I'm betting that this is not a 1, 2, 3 leg, but this is a 4-leg expansion. And I'm going to start building the position in expectation that I'm going to break this, and then your profit target becomes this liquidity line level. So now your risk is basically from here to here. Now you came up with that idea based off of looking at what are they going to do with this liquidity, and we're getting a reaction off this expansion. So these two lines have defined that range. I'm not making this stuff up. I'm just walking through a series of questions based off of what's happening here on the monthly. And as you can see, if you guys ask these questions and you look at it, you eventually will lead yourself to some sort of trading idea. You know, so anyway, that's really there's a possibility this could be a really good trade. Really good trade. You can see that the architecture's stacking up. We got red boxes above. If it holds above this one, beautiful, especially if it pushes down over the next few days and we get down to that exact level, man, then you're even closer to your risk. And if it comes around, you know, that's a knock it out of the park. That's one of those trades that adds to your year. So again, something to think about. Is it going to work out for sure? I have no idea. I got no idea. But I would say it's really going to be contingent hanging above this liquidity line level, and we have this expansion line level that's going to kind of coordinate with that same price. So between those two, see what happens in real time, and possibly could lead to pretty good trade. So if it's something that you want to work, and this trading the daily fits your schedule, you could manage that effectively. All right, guys.
Real quick before you wrap it up, I just want to make one comment about this. So looking at that last range, so that second to last red box on your daily chart, we can see that formed an expansion range. Price wasn't really trending at that point. Formed an expansion range, and this was kind of a leg of expansion, that whole run up. We haven't seen price settle. So to Wade's point, you know, if we see it pull back and then we get a little bounce off of that expansion line again, that one that's jutting out a lot further, if we get a pullback to that, then we could very easily see price settle and then, you know, start continuing up to the long side. And it would make sense in terms of the monthly, because we know that when it hits expansion lines, the chance of it taking a breath but then continuing in the overall run are very high. And then going back to the pound dollar example that we showed at the beginning with the volatility report, this is nothing out of the ordinary for it to go and excuse me, push up and then pull back to a previous expansion line, and that's where the breath stops, and then it goes back into the overall direction it was heading in the first place. So just when you see those pullbacks, you know, and you don't quite know exactly where it's going to go, just look to the previous expansion line on the way up or down. Look, you know, start with that, and I think you'll find that you get a lot of rotations or a lot of good trade placements at some of those previous expansion lines.
Yeah, this is, I think this could be a decent opportunity. And like Shane said, this hasn't, it tried to settle right here. You can see it came down, we had a swing low, didn't hold, wanted to go attack the swing high, so it did. Now we got another one to work with up here. So could this be the settling point of this previous box? And then eventually we work our way up. Can this come back around blue on this monthly candle and work up towards here over the next maybe 4 or 5 months? Maybe faster, I don't know. You know, because that would be a swing high point of origination that you got back here. 1, 2, 3, that'd be the 4th leg on that. Like I said, I have no idea what's going to happen, but we have the sensitive points that define our risk and give us clues. And so when the market interacts with those points and gives you the clues, enough so to where you see the painting clear enough, you eventually start taking action, and you're going to be right some of the time, you're going to be wrong some of the times. But as long as you're following the rules of keeping your risk low and keeping your upside, your general upsides bigger, should be okay. Just don't over leverage and don't get upset when you're wrong. You're going to be wrong. Everybody's wrong. That's you cannot avoid being wrong. It's going to happen. So just be prepared for it and move on to the next opportunity. So, all right, guys, I think that's it. So sorry we went a little bit over time, but hopefully you guys got some decent insight from that. Just like I said, the biggest thing you do is keep your leverage low, and so you could stay creative and you can flow with the market. The minute you start over leveraging, you're really going to cut off your ability to be creative, and that pain response is going to come in. It's going to make sure that you get cleaned out and that you stay a loser. That's what's going to happen, because remember, you don't have to learn anything to lose in the market. It's natural. So the more risk you put on, the more you'll be susceptible to that. So stay creative, and the tighter you get to your risk parameters, then the heavier you can go, because you're not really risking anymore. You know, you're just much closer to the defining points. So thank you guys so much for being on. We'll plan on seeing you guys next week, Tuesday at 10 a.m. Hopefully the time change didn't mess people up too much, because we have daylight savings time here. But we'll plan on Tuesday, 10 a.m. Pacific Standard Time. You guys, if I missed any of your questions or anything, always feel free to email us at support@tradeats.com. We're there for you. We want to help you as much as we can. Remember, we're in this for the long run, and hope that you guys are too. So we're there for you. Anything we could do to help, we will. Till then, just stay safe, trade safe, and we look forward to seeing you guys next week. Thank you guys so much.